where are we with asset prices from a more secular dynamic, right? When you look at what's going on in the bond market, we talked about last time this pressure on the long end, and particularly around the term premium in bonds, and where term premiums in U.S. bonds were basically as low as they've been in a long time. And over the course of the last 6 or 8 weeks, we've seen a meaningful steepening of the yield curve. We've seen that long end move up, and we're starting to see term premiums get into the range, really the upper range of where they've been over the course of the last 15 years post financial crisis. Now, where they settle, where the end buyer finds value in that term premium, it's kind of uncertain. But if you think about it, sort of the average term premium on a 10-year bond is what's shown here on the left-hand side. Back in the sort of pre-crisis days was about 100 basis points. In the post-crisis days, it's been about 0 basis points as significant liquidity was used to bring down the long end. What's the right number? We're probably going to start to see value in that sort of 50 basis point range on sort of the high end of the recent numbers and on the lower end of long-term conditions. And so that's really when you start to get those bond yields into the high 4s and low 5s, that's really where you start to see the value. Now, does that mean the bond yields could go higher? Of course, bond yields could go higher, but I think we're really starting to see value, and even the intermarket action today gives you some indication that once you get the yields into that range, there are folks who are looking at that, seeing the term premium, and saying that might be a pretty good deal. The main outlier at this point in terms of term premium is the equity premium, right? And so that's what you see here on the right-hand side. What is the kind of, with bond yields at 5%, let's say, give or take, you've got to be pretty confident that you're going to get substantial earnings growth in order to hold the stock market that is also giving you a roughly 5% earnings yield, right? And so I think what you see here in this chart is basically the equity term premium, or the equity premium above bonds, is basically the lowest it's been in 20 years, and is starting to move pretty quickly to a level that's on par with bubble-like conditions in the past. And so I think this really kind of gives you a sense, of sort of sets up a basic perspective on what's going on across assets, which is essentially the term premium of money, right? Which is, you can see in the bond market, is basically at the lowest it's been in 20 years, give or take, right, in the post-financial crisis period. But the premium for equity is at the highest it's been in 20 years.